Talk about life insurance as part of the financial plan this morning for Money Mondays with the help of Peter Fraser, certified financial planner with Credential Financial Strategies. Good morning, Peter.
Good morning, Rob.
Now, I've actually never heard of this, and I'm really curious about knowing more. It's called either second death life insurance or joint last to die insurance. Tell me more about this.
Exactly right. Yeah, I thought we could talk a little about this morning. It's a key planning concept that I think can play a really important role in that estate planning piece of a good financial plan. And I think it's also good to remember that life insurance of a lot of variations can often play as vital a role in the financial plan as that well-constructed investment portfolio. So it's a great tool to have in the kit, and here's why. This one specific kind that you mentioned, called last to die, or sometimes called second death life insurance, can often be used for married or common law couples. And that's expressly because most of the expensive taxation now hitting individuals and their estates in Canada gets a rollover provision at the first death, Rob. So it's kind of like that get out of jail free card. We only get one, but it does result in the big tax and estate-related costs not hitting until the second death in these relationships. And that at that point, it can really bite. So you know this stuff, but the backstory here is that most couples commonly own various assets, and a big portion of those can sometimes be the registered ones. Those would be the RSPs and the RIFs. And those are considered fully taxable as income in the hands of the person who dies last. And those accounts in Canada can be worth hundreds of thousands of dollars. So lots of income tax on that.
Okay, tell us a little bit more. What else do we need to know about it, Peter?
Yeah, well, investment portfolios are also considered sold at the death of the surviving spouse. And here again, all the profits on the portfolio, like capital gains, have to be calculated, and those taxes have to be paid. Ditto with those recreational investment or family cottage properties. They're deemed to be sold. And, of course, there's no capital gains exemption relief on those like we enjoy in our principal residence. Just to pile on, as if that's not enough, there's also what we call estate administration tax, or EAT, if you can believe that acronym. and that's in place in Ontario.
That's fitting, actually. That's fitting, Peter.
Yeah, I thought so too. But it's called probate, or what we call probate. That's the provincial comprehensive fee that's levied on the entire estate at the point of filing your will. So, lots of costs. But it can be possible to build a compelling solution to these by using this special kind of insurance you referred to off the top. And in that case, we basically construct a tax-free death benefit that arrives at only and exactly the same time that all these costs are due and payable, and that's almost always at the second death. So just FYI, these second death policies are personally owned. They're created by using two lives, and actually that results in an equivalent age that's almost always lower. So can be quite a bit cheaper when it comes to the insurance cost.
Yeah, because, I mean, if people go shopping for life insurance, the way the actuaries work, it's very dependent on age and you know, certain health outcomes and lifestyle choices, these sorts of things. But under this type of policy, the premium can actually be based as though you're younger, right?
Correct,
so
yeah. Like two 50-year-olds can equal the cost of one 38-year-old, as an example.
Right. Isn't that interesting?
Yeah, important to remember, you have to qualify. You can't just sign up for these like you do for an RSP or an investment product, but it can be a great tool to mitigate the erosion we're seeing on these increasingly larger estates. It really does help when it can be used to maintain the value of that lifetime of hard work, of good planning, of wealth creation. And just before we conclude, offer two or three specific ways that people can use them. Of course, they're dependent on a person's plans and needs, but some of these policies offer tax-efficient access to cash values, so there's the potential for income replacement. A big one is charitable donations, Rob. And in this case, a family's favorite charity and a gift to that can offer a legacy impact, of course, but it also offers a very nice receipt to offset taxes. And oftentimes you're swapping out paying CRA for paying the charity, and people prefer that. And you could use these things for things like loan repayment, debt elimination. So these are tax-free benefits, remember, and they often can be used to help pay down those balances. I've seen accelerated and private inheritances. So sometimes to your children, sometimes to the grands. We can name them as beneficiaries in structures like this. And if you think of sometimes education and housing, which are becoming out of reach a couple of generations down, it can be helpful for that. And, of course, the last thing is probate planning in any policy, but especially these. You can name individual beneficiaries as opposed to just your estate. So anytime you name a beneficiary, it can help to reduce those probate fees we talked about. And doing so also provides very high privacy, because remember that a will and everything in it can become public information, and we've talked about that before. So that's the primer this morning on insurance and how it can help in the estate planning piece of a good financial plan, Rob.
Yeah, but a lot of moving parts, and maybe an eye-opener for some people, about the many, many things that really should go into an appropriate estate plan. So that's why I recommend that people would get in touch with you at Money Mondays at Alterna.ca. So thank you very much, Peter, for this morning.
Thank you, Rob.
Great stuff. Really interesting. Yeah. Credential Financial Strategies, certified financial planner, Peter Fraser.